Welcome to our simple explanation of why the stock market reacts so strongly to inflation. One inflation report can move billions of dollars in minutes, but the reason for this dramatic impact is actually quite simple. Why does the stock market react so strongly to inflation? Let's break down the basic connection. Inflation means the prices of goods and services are rising. Things like food, gas, rent, travel, and everyday products become more expensive for everyone. The core issue isn't the rising prices themselves, but the reaction high inflation triggers from central banks. When inflation stays stubbornly high, investors worry that the Federal Reserve may keep interest rates elevated for a longer period of time. Higher interest rates make borrowing money or getting loans more expensive. This affects both companies looking to expand and consumers making large purchases. Next, let's look at how high rates and inflation squeeze company profits and influence investor behavior. For companies, inflation can directly increase operating costs like wages, raw materials, shipping, and their own borrowing expenses. If costs rise faster than their sales, company profits come under pressure. Also, when interest rates are high, safer investments like bonds look much more attractive. This means some investors will sell stocks and move their capital into these safer assets, causing stock prices to drop. It's important to remember that inflation isn't the only factor driving the stock market. Strong company earnings, significant AI technology growth, and overall investor confidence can also push stocks higher, regardless of current inflation figures. That is why, even during periods of inflation worry, you might still see positive performance in major indices like the S&P 500 as other factors come into play. Let's summarize the straightforward chain reaction that connects inflation to stock prices. Here's the simple chain. Inflation goes up, interest rate fears increase, company costs rise, profit expectations fall, and eventually, stocks can drop. Conversely, when inflation cools down, investors hope the Fed may pause or even cut rates. Lower rates support business growth, cheaper borrowing, and boost overall stock market confidence. Let's wrap up with the key takeaway for understanding this market dynamic. The simple rule is this: high inflation is usually bad for stocks because it can lead to higher interest rates and ultimately lower profits for companies. Controlled inflation, however, is generally better because it supports confidence, stability, and growth throughout the entire economy. If you want simple finance explanations without complicated language, subscribe and follow for more market updates.
For daily stock market news, business updates, and simple financial explanations, subscribe to our channel. Like, share, and press the bell icon for the latest updates.